While a long call offers unlimited theoretical profit, a bull call spread can actually double your return on capital in high volatility environments by lowering your break-even point. Every bullish options trader faces the same dilemma. Do you buy a naked long call for unlimited upside, or do you use a bull call spread to lower your cost basis? The answer depends entirely on the hidden costs of leverage. A long call is the purest form of bullish leverage. You control 100 shares for a premium, and if the stock moons, your profit potential is theoretically infinite. However, you are solely responsible for paying the entire premium. A bull call spread, or debit spread, involves buying that same call, but simultaneously selling a higher strike call. You cap your potential profit, but the premium you receive from the short call drastically reduces your entry cost. Let's visualize the trade-off. The long call continues up forever, but starts deeper in the hole. The spread flattens out at the short strike, but note how much closer the profit zone is to the current price. The most critical factor here is the break-even point. Because the spread is cheaper, the stock doesn't need to move as far for you to start making money. This statistically increases your probability of profit. Here is the math. For a long call, the stock must rise above the strike plus the full premium. For a spread, you subtract the credit received, lowering the hurdle significantly. Consider the return on capital paradox. If a stock makes a moderate move up, the spread often yields a higher percentage return than the naked call because your denominator, the cost, was lower. However, if the stock explodes and rips through your short strike, you will feel FOMO. You stop making money while the long call owner keeps profiting. This is the price you pay for safety. Let's look at the ROI comparison on a 5% stock move versus a 15% stock move. In the moderate 5% scenario, the spread creates profit while the long call might still be at a loss. Now, we must discuss implied volatility, or IV. Long calls are long vega, meaning they need IV to rise or stay high. If IV is high when you buy, you are overpaying for the option. This is where the spread shines. When you sell that upper leg, you are selling expensive volatility. This offsets the vega risk of the long leg, making the trade much more resilient to IV crush. Use this logic for your setup. If IV is low, buying a naked call is acceptable because premiums are cheap. If IV is high, you must use a spread to offset the inflated prices. Next is Theta, or time decay. A long call bleeds value every single day the stock doesn't move. It is a race against the clock where time is your enemy. In a spread, the short option also suffers from time decay, but that is good for you. The decay of the short leg helps cancel out the decay of the long leg, preserving your capital if the stock stalls. Here is the side-by-side Greek comparison. Notice how the spread neutralizes both theta and vega, trading raw delta, directional power, for stability. Psychologically, most traders lose with long calls because they overestimate the target move. They pay for unlimited upside that the stock rarely achieves within the expiration window. By selecting a short strike at a technical resistance level, you aren't really capping your gains. You are simply monetizing the unrealistic portion of the move to finance your trade. When choosing strikes for a spread, a common setup is buying the 50 delta at the money and selling the 30 delta out of the money. This balances cost reduction with ample room for the stock to run. So, which strategy should you choose today? It comes down to a simple 3-step checklist regarding volatility, time, and target. Follow this flow. If you expect a massive breakout and IV is low, buy the call. If you expect a grind up or IV is high, the spread is mathematically superior. Let's summarize the key differences one last time. Pause here to screenshot this comparison table for your trading journal. Ultimately, the bull call spread is the professional's choice for consistent income, while the long call is a precision tool for specific low volatility breakout opportunities. Choose the spread for consistency. Keep the call for conviction.